We're joined exclusively by Magnum Hunter Resources CEO Gary Evans and today's panel. Gary, welcome back. Good to see you.
Good to see you again. Thanks for having me.
Let's begin with the discussion we were just having. Is it your anticipation that the oil price stabilizes from here, moves higher, or moves lower?
You know, it's a question that everybody wants to know. On the good side, the rig count has continued to drop every single week, going on 7-8 weeks now, down to close to 1,000 drilling rigs. The bad news is we have the highest oil inventory in storage since the 1930s. So we got too much oil, but the rig count is dropping. And what is different this time is that these shale plays have a much more dramatic decline rate than the conventional wells of the past. So I think that will have some impact, and hopefully we have stabilized.
Bringing in the panel here as well.
Yeah, Gary, I want to ask you a question as an investor, but through the eyes of a CEO in the oil sector. I'm watching this rig count decline, almost 20% now. I'm going to assume it goes down to 600, okay? I want to be very conservative. But I haven't seen a commensurate decline in barrels production. It's actually going up, so it must be that you guys are keeping your good productive wells open and shutting your crappy wells down. And so when do I actually see a reduction in flow? Because I'm getting really nervous that in the next couple of months there'll be nowhere to put the next incremental barrel of oil. Nowhere. It'll be valueless and worthless to me, and the price is going to go into the 30s. That's my concern. You're
going to see the drop. Now, you got to understand, the drilling rigs that are still out there drilling, a lot of companies had contracts, 1, 2, 5 well, 6-month contracts. So those contracts are coming off every week, and that's why you're seeing the rig count drop so dramatically. But the production doesn't drop overnight. You know, it takes about 2-3 months. So you'll start seeing it, mark my word, especially in these shale plays.
Can you talk, Gary, a little bit about some of the plays that you're focusing on now in terms of investment and production? Because it looks like Utica and Marcellus shale in Ohio and West Virginia, you know, we're used to thinking about, obviously, the Dakotas and Texas and focusing a lot of our discussion there. But what about these areas? How productive do you expect these properties to be?
Well, we made a decision almost 2 years ago to sell almost all of our oil properties. So the last 1.5 to 2 years, we've sold over $700 million of our oil properties when oil was around $100+ a barrel. We made a decision to focus totally on natural gas. So we're 90% natural gas today. We believe that's the future for the U.S., and we obviously have more control of that. We think industrial demand, chemical demand, LNG demand will continue to drive natural gas prices up. And of course, with this tremendous cold weather, prices have been moving in the right direction over the last week.
Well, now let me just take a little bit of an issue with that. Natural gas prices, that was like the first piece of the oil crisis or collapse that's just happened. I mean, those prices have gone nowhere but down. Do you still have confidence that they're going to start moving higher over the medium term, or are we seeing here what could happen with oil where everybody stays invested, keeps producing, and the price never rebounds?
Well, see, what's changed is these shale plays like the Marcellus and Utica, we've learned now how to discover these reserves at 50 cents an MCF. So the fact that gas is $2.50 or $3, we're still making a 40+% internal rate of return. So that's what's changed. Years ago, we needed $2 gas because our finding costs were $1. We needed $3 gas, $4 gas. So we've learned to operate in a lower commodity price environment. Same thing's going to happen on oil. We'll continue to drive costs down, and we'll be able to operate at $60 oil.
Is there an investment thesis that says gas and oil stocks will finally decouple? Because they haven't yet. So if I want to go back into this sector, I'm I'm way underweight now because I don't like what I see in pricing. I'm nervous about inventories. But if I'm going to redeploy capital, should I just buy the gas names like you and say at some point the market will start to differentiate these equities? Because they haven't done any of that yet. We hate both of you a lot.
Well, there's no question all of our stocks have been pummeled, you know, since Thanksgiving. I don't know what kind of bad turkey we all ate, but it wasn't good. So I will tell you this. The thing you need to look at, don't look at oil and don't look at gas. Look at the rock. That's what it really boils down to. If you have really good rock in good oil plays or really good rock in good gas plays, you can make money at lower prices. It's the companies that don't have the core in the plays. You're in the middle of you're on the outskirts of the play or on the fringes. So it really boils down to the quality of the rock, and that's why we concentrated in the Marcellus and Utica on our lease.
Well, I didn't do that well in geology, so I'll take your word for it. Gary, thank you so much for being here this afternoon.
Thank
We'll
you.
be following along closely to see what happens. Gary Evans, CEO of Magnum Hunter there.